Okay, well, let's go ahead and get started. I know folks are still coming in, but hello, everybody. Good morning. My name is Emily Rice. I'm CEDAM's Director of Communications and Training. Thank you for joining us today to discuss the upcoming June LIHTC funding round, but also into the future. And we're going to get into the status of the equity market today and give you the opportunity to ask some important application questions that you may have. So, of course, right now we know that safe and quality affordable housing is needed in Michigan, and COVID-19 has really only put an additional spotlight on that need. So thank you for being here and wanting to join in this discussion. You may know that CEDAM typically hosts a one-day in-person event in August to discuss the equity market and changes to the QAP. And the planning committee, the members for that event, who are all panelists today on this meeting, felt strongly about connecting with you and updating you and giving you all the chance to ask some questions during these uncertain, I know we've heard unprecedented times a lot. So I want to thank them, each and every one of you, for being on here and helping plan this and giving folks the opportunity to chat with you. So before I introduce you all, I do want to run over a few logistics. We will be starting today with our equity market conversation, and then we'll have some time for Q&A after that. And then we'll move on to MSHDA and hear updates from you, Chad, and that will also be followed by time for questions. So folks, all of our panelists, our participants, please submit your questions through the chat box. Because we have so many folks on today, I won't be unmuting anybody. And you can either broadcast those to just panelists, or you can choose panelists and participants, depending on if you want the rest of the group to see your question or not. So that's totally up to you, but no matter what, we as panelists will be able to see your questions, and we will do our best to get to all of them, time permitting, and sort through them and make sure that we're not asking repeat questions. So feel free to ask those as we go so you don't forget your question, but know that we will probably get to it at the end rather than mid-discussion. So with that, today we have Chad Benson from MSHDA, Macy Kisilinsky from Alliant Capital, Ben Stehouwer from Cinnaire, Mike Jacobs from National Equity Fund, or NEF, and Spencer Singer from PNC. So thank you all again for being here. And we're going to kick things off today with one question that I'm just going to ask each of you. So we can just go in the order that I see you on my screen. And that question is, what is the current status of the equity market? So Mike, you are top left on my screen. I will kick it off to you first.
You know, it's sort of interesting. When we all went home, we sort of expected that it would probably slow down a little bit, and it, for NEF at least, it hasn't. Sort of had a record first quarter and moving into having the beginnings of a really solid second quarter. But what we're seeing is not a pull out exactly, but a slowdown in how investors are looking at deals. Number of the large ones are saying, we want to work with our repeat sponsors. We want to work with people that we've worked with before, people that as a syndicator. We don't want to go into looking at somebody who's new right now. They're depending on where the CRA investors are in their cycle. Some of them are slowing down, saying, we'll see what happens in the fourth quarter. We'll take a look in the fourth quarter to find out what's going on. But what we're seeing is they are actively looking. They will look at deals when you bring them in. So like I said, every panel, when you get an award, or when you're putting in your application, when you're taking a look at your deal, get it to your syndicators early, so that we have time to actually shop it around. It's taking a little bit, at least I'm finding it's taking a little bit longer to get approvals to actually bid deals now than before we went home. But there's still active investors out there, and we're trying to work with all of them.
Great, thank you, Mike. Ben, how about you next?
Yeah, so a couple of similar themes, as Mike was just saying. I mean, in general, uncertainty is not good for the investor market, in any market. That's in the LIHTC market, that's in any capital market uncertainty is not a good thing when we're certainly living in uncertainty. I think that what we've seen is investors are standing by their commitments, to date, whether it's if they've made a soft commitment to be in a multi-investor fund or a commitment to do a deal, they're standing by those. We are, as I think similar to what Mike had said, we are closing deals right now. We are signing up deals right now. So I think there's the current with where we're at right now, and then kind of looking ahead for the months ahead. So they are standing by current commitments, but I think there's a little uncertainty moving forward. I think what we're seeing is CRA investors that have need are actively pursuing deals. We've heard the same thing, that they want repeat sponsors. It's very hard to get credit departments comfortable with new developers, new sponsors, that they really have to right now underwrite. If they have repeat business, that's certainly a good thing. So the CRA investors have a need are active. If they are at the beginning of a cycle, there's uncertainty, not just with COVID, but also CRA reform. So we have a couple of things in play that they're moving cautiously, I'd say. They are looking at deals, but still saying they're uncertain about what the need is going to be for CRA reform, uncertain on yields, given the situation with COVID, how this plays out. I think the other piece, so that's the CRA investors. We've seen economic investors. What we've seen, what we've heard in the market is that some yields are starting to climb for economic investors, because there is a little bit more cautious moving forward. So if you do have fewer investors, that's what would happen, is yields would have to increase to attract those investors. So there is a possibility for that moving forward. I think something, we've been stressing at the deal level quite a bit. I mean, there's concern about timing, about construction timing. Will there be delays? How are deals being impacted? All these things that are kind of a new reality. Something that I've been a little bit encouraged recently by is that we saw, at least in the state of Michigan, construction was the first activity that was brought back on as far as opening the economy again. So if there are future waves in this, I mean, we've been stressing for a 4-month delay. What about an 8-month delay in construction if there's multiple waves of this? I think that we have a little bit better idea that there is a way to navigate through construction. There's a little more certainty there. So that's, I think a good thing. In as far as banks' appetite for tax credits, some of the unknowns going forward is, will they have reduced quarterly earnings? Will there be as much appetite for a tax credit if they have lower tax liability with less earnings? I think there's still some uncertainty there, a little too early to tell. But I think overall, investors are moving forward. They are a little more cautious, keeping by their current commitments. But as we move forward, I think we should prepare for yields to increase some in an uncertain market.
Thank you, Ben. And Spencer, I will kick it off to you.
Sure. I would say the same thing as Mike and Ben have said. I think on the syndication side, there's some investors that have pulled back. There's also investors that have just stayed the course. Right now, it's kind of a moving target, but PNC is still looking at deals directly to buy the credits directly, just for the bank's balance sheet. And then also from a multi-fund and proprietary distribution, we haven't seen too much pullback. I think what Ben said about yields going up is true. I'd say on average, we've seen about a 3-penny drop in pricing. That just kind of feels like where it's at right now. But PNC is open for business. Obviously, if you have a repeat relationship with a developer, I think that really helps add security to a project. But it's also an opportunity right now for PNC to work with others that we haven't in the past. And we're seeing that across the board, across the country. There's I think some of the larger investment banks, they've kind of paused on doing many deals this year. I think that will continue through the third quarter, and then fourth quarter, it'll kind of balance out. More of what Mike and Ben said. I think most you're going to be able to find an investor. And it's just, right now it's kind of a change. It's changing every single day. So, you know, we're all working through it. And I don't think it's one of those things that developers need to be too worried if they get a 9% award. I mean, that's a good challenge to have. But it's definitely a different industry right now, but we'll get through it.
Thanks, Spencer. And lastly, Macy, I will pass it over to you.
Oh, well, I'll go along with my colleagues. And I think, well, I'm going to go off on a little bit of a different tangent. I'd say this much, that if you have a deal that's signed up, you know, you're going to close this year. I'm more concerned about the deals going forward. So people that are putting in applications to MSHDA now for the June round, you know, what is that going to mean for them when and if they get awarded, and what their pricing is going to be. And I think that's going to be the real challenge here. I think this, depending on how long the economy ends up in contraction, will draw, and where the losses really hit. I mean, I know it's hard to put the puzzle together, but in some way, many of these commercial establishments, REITs, commercial real estate is really going to come back to banks in particular, you know, and that's going to take a big chunk out of their balance sheets. They're going to show a lot of losses. So right away, if you're thinking about doing a 4% deal, you know, you've got to be aware that if you're very loss heavy on a 4% deal, that for the next, you know, 12 months, that may not be the best way to go about it, because, you know, the way this affects, you know, most banks' balance sheets when it comes to heavy, you know, deals with heavy losses. So I would say this much that might differ, that I think this might last longer than most people think. I think that even with stimulus, it may not make a difference. I think what's going to happen is we are shifting, as I'm sure my colleagues will agree, from a seller's market to a buyer's market. And for those of you that have been through 2008, 2009 in this industry, you know, it was a very not subtle change. It was a real change where, you know, things like underwriting standards start to tighten up just across the board, because they can, not because it's the deal warrants it, it's because they can. And so things like repeat sponsors, location, strength of sponsors, strength of deal, all of these things are going to play into the decision making. And unfortunately, this is going to be the nature of the beast for, I think, you know, the next year, is that investors are going to want the cream of the crop. So if you're in a location, or if you're underwriting a deal and you're doing some things that might stretch in terms of rents particular, or lowering operating expenses, or making certain assumptions about how much debt you can have, or trying to get your pay-ins to be more aggressive, you know, those things aren't going to really work. And so the advice I would give at this point is to say that, you know, you want to try to be more conservative. If you think you're being conservative, be more conservative. And then I'd agree with Mike. Get your deal to your trusted syndicator early. You know, let us give you some feedback, because we're getting feedback on a daily basis. And so this whole situation is changing, not hourly. I think that was like 2 weeks ago. Now I'd say we're weekly mode. And it will depend on Treasury and what they will do, the 4% rate, how much, you know, we got all kinds of things flying out there, I think, but it really starts with the developers trying to sort of begin with a product when you're thinking about your project going forward and how that's going to be underwritten. And that if you do that now and you get awarded in the next round, it's going to pay dividends for you when you actually go to closing. So in summation, I'd say that, you know, focus in, try to build the best project that you possibly can, and I think the rest will take care of itself.
Yeah, I think I agree with Macy on that. And there's, you know, a couple of things to add. You know, depending on, you know, if you're going with a proprietary investor, and we sort of see it bleed, right? What happens on the coast eventually bleeds into the middle of the country. And like Macy said, we're seeing what had always been 3 months worth of reserves in California, investors now going, I can get 6. I don't have to stress it, you know, and in this uncertain time, I want 6 months, even in markets like San Francisco. Other things that I worry about is we just saw, you know, if you read the article, that the city of New York is clawing back $1 billion in soft money, even for committed projects, and saying we're moving, you know, we're taking this money back because we need it for the city. And we'll just have to deal with the housing problem later. So, I'm keeping a close eye on that. Other things to keep an eye on, and I don't know, and I apologize, and Chad, maybe you can answer this for me on this call. I don't know where MSHDA stands on this, but like Oklahoma just extended all of their deadlines by 12 months. Indiana's done something similar. States are looking at that because we're not getting any feedback from the Fed. So we're looking at the states to make those decisions. So those things all to keep in mind as you move forward with your deal. There's a lot of moving parts here, and while people are still looking at deals and still investing, they're keeping an eye on all those other parts and asking questions. If you've got, great, we're open up, we can do construction. You've got an in-place or a tenant in place rehab. What's your policy? And they have put out a huge thing to all of our developers saying, before we invest in this, you have to answer all these questions about how you're actually going to handle this relocation for this particular project. So keep in mind, there's going to be a lot of other questions you're going to be asked as you move forward.
Yeah, I mean, I think I want to echo on something Mike said, is that there will be no safe haven for any deal, and that you should expect as developers that your investors, guys like myself and Ben and Spencer and Mike, maybe not Mike, but some people who work for Mike, who are going to say, well, tell me about what your balance sheet looks like now. I don't care about last year. I don't even care about last week. I want to know about now. And so, and we're going to it's going to seem like this haphazard thing, but that's how this thing's going to materialize for right now. There's just going to be all this pressure to say, these people, how are they dealing with the downturn? How are they, where is their balance sheet going to be? Do they have enough, liquidity to make it through? So you're going to see all these questions sort of filter through, and it's going to seem like haphazard. It's going to seem, it might hit at different times. And so those things you should to be expected. And what I think we would appreciate, and I can't speak for my colleagues, but I think I would appreciate, is that just to say, thank you. We understand, and we'll get you the answer. And we're not asking these questions to be difficult about it. It's just that's what's being posed to us. So, we all try to be patient, try to build the best deals that we can and work with you. But I think, should understand that these investors are really, to get to the cream, they're really digging down and sort of challenging each deal as it goes.
Thank you, guys. Does anybody else want to echo or add on to anything before we get into some questions?
One other thing, just to add, I think I agree with all that's been said. And one of the things that we are starting to really focus in on too is is there a cushion in rents? What are we projecting as AMI growth? I think there will still be demand for affordable housing, certainly, because if there is a recession, you may have more people that qualify. But we are, if there is rental assistance, I think that's very good. If there's not, we're saying, boy, if you have rents that are close to max rents and you're going to need that, moving forward to meet your debt cover ratio, that could be a concern. If we see AMI levels, stagnate over a couple of years, that could be problematic trying to get to that conversion, especially if it's, a deal that's relatively tight. So I think just another piece to look at. But that's just, overall, I think being conservative in just about all areas is good right now, because whether it's the rents, whether it's the timing, whether it's, reserves needed, all those things, we're going to be requiring more, or being more firm on those requirements.
Great, thank you. So we do have some questions, and this first one is a multi-part. Spencer, I think you answered this first one already. Is there a difference in execution in proprietary versus multi? So I don't know if you want to expand on that further, anyone, or if you want me to move on to the next one.
No, the good question. What we've seen is that there are certain investors that, one specifically that really hasn't changed any of their underwriting. They've kept the yields where they were this whole time. So they haven't really, nothing has really changed with them. So that's something that is a little bit different than most. Most are, asking for a little bit better yields. And then, like everyone else said, certain underwriting assumptions need to be stressed. I think the one area that is probably most concerning and most challenging is AC rehab deals, where you're going to have tenants in place. I mean, I don't even know how you can navigate through that right now with COVID. And then also just leasing up in general at the back end. Maybe you would typically have a 4-month lease up. Right now, we're saying let's stretch that a little bit to make sure that there's enough cushion in there to make sure that the project can get leased up in a realistic time frame. And then obviously construction. I've seen it with projects right now that are in the process of closing. There have been delays by about a quarter. That kind of seems like the average right now. So I would say those are the 3 things that any investor is going to look at, and they're going to want to make sure that they have a project that is realistic and timely, and is also conservative to make sure that the project can work. And if it leases up, or construction is wrapped up quicker than what we had projected, that's great. It's good for the development, good for the developers. So it varies between each investor.
Yeah, I would also say on the multi-fund, I think you'll see this again, and we've seen this in the past, where you bring your deal to any one of us, or maybe a couple of us here, and one of us is quoting a price that's 5 cents higher than the other one. Keep in mind that when we put together multi-funds, we put them together and then they eventually have to close. So if we've got an old multi-fund and we have a hole in an old multi-fund and we're taking your deal, well, there was a particular return target for that fund. And the return target might have been fairly low because it's an older fund. If we're looking at deals going into a 2021 fund, when we don't know what investors are going to do in 2021, we have to jack that return up. It has to be higher to make sure that we attract investors that haven't committed yet to a new fund. So you may see a difference in pricing depending on who you go to at any given time, depending on what fund or where we're actually going to put that deal.
Thank you. So part 2 was, our regional smaller banks under 50 billion not able to pivot as quickly or determine appetite?
I think I kind of feel like they're the ones on the front line, with commercial real estate. They're the ones that are making these loans to small businesses primarily, that are, they're making business loans to commercial developers to build, whether it be little office buildings or mixed use structures. When I say little, I'm saying, these are, very large projects, by tax credit standards, but little by, smaller than what you would see with these large banks. And so I think they're going to be on the front line, quite frankly. I think when you see like the subway that has to close and has to close up shop and can't pay rent, or some other local little restaurant that sort of filled the commercial corridor in a particular place, that's going to hit these regional banks. And even with all the other precautions that have been thrown out there, I think once they sort of get an understanding of what that loss might be, if that's their book of business, I think that's where we're going to see a problem. And so where, you might be able to get a regional bank to sort of buy a tax credit deal, either by a proprietary or a multi-investor fund, these folks are going to be like, whoa, I don't care where it is, they're just not ready to sort of make that decision until they, they just don't have that kind of capital. I think that's part of the problem. So yes, I think the answer is they can't pivot as quickly, and I think they're the ones who are going to have to really see how this all hits their commercial, their commercial portfolio. That's.
Yeah. So, something that I, even at the onset, maybe you should have brought up is one of the first things we've heard from banks and investors is that they're not as concerned about low-income housing tax credit investments. Currently they have, loans in business, in hotels, in retail, in so many different spaces that are impacted now, this week, next week, this month, that they are forced to turn so much of their attention, and particularly, their credit folks really focusing on other sectors, that that's, part of I think what plays into, we're going to keep our current commitments, kind of like we got bigger things to deal with right now. multifamily real estate is, you know, in general, pretty stable when you compare it to these, you know, the retail industry right now, or restaurants or hotels. So they are focused, you know, in those ways too. So I think we have heard, you know, there's, you know, with other pipelines in different areas, credit folks really having their attention there, that that is kind of making it a little bit more difficult to move forward or to pivot to a new reality in our market. So I think we'll see that start to come, but that's something to consider too, that it's not, especially when you work with a smaller regional bank as well, you may have credit departments that aren't solely focused on the affordable industry or solely focused on low-income housing tax credits. So when you start spreading capacity, that may be something that makes it a little more challenging as well.
Thank you. So part 3 is, hasn't PPP been a burden? Isn't debt king?
Well, I guess I can lead this one off. I know that last year PNC processed about 300 PPP applications. I'd say 5 weeks ago in the first round, PNC did 88,000 in, I would say, 2 weeks. So it's been, I mean, it's been a great tool for small businesses to access capital, and it's been extremely important to get them that capital. It's taken, I mean, from the bank's perspective, it takes a lot of time to process that, and that was a very huge undertaking for the bank. But you know, we're working through it. But I know from the CDB side, that took up a lot of time, and you know, I think it's not a burden. It's just doing what we have to do to make sure that the payments can get out. But if you feel like you have an opportunity to access it, I think it's a very positive thing. So.
Great. And the last part, and feel free, panelists, if there's a question that you feel like you've already touched on enough and you want me to just move on, please feel free to say so. But this is, what are COVID underwriting concerns?
I mean, I first go around was just delays, you know, delays on construction. You know, what does that do to, you know, pricing, you know, I'm not to pricing, but to negative timing adjusters. And actually, I think most investors were most concerned about placing in service. I really don't think that's much of an issue. I think that is easily solved in most jurisdictions, especially with MSHDA. I don't think that's an issue. I'm more concerned about, you know, really getting subs on the job, being able to finish on time, you know, exposure to construction period interest when you can't finish on time, you know, and then it's the negative adjusters on deals, negative timing adjusters, because you might lose a month. So you're really not going to run a problem of placing in service. It's really between the syndicator and the developer. And we have this force majeure issue that's out here. And there doesn't seem to be, at least that I've heard, and, you know, Mike and Ben and Spencer, correct me if I'm right, I've not heard anybody talking about a solution for the negative adjuster, the negative timing adjuster, because that's what we're all going to be facing. And so it's not necessarily going to be the big loss, it's the little loss. And I know all of us are expecting that the new language for force majeure in all of our limited partnership agreements is going to now explode, which was once a paragraph, is now going to probably be like 10 pages. So everybody should expect that. But I think in general, I mean, I think that's my biggest worry about COVID. It's not going to be just this pass go around, and not just in Michigan or Pennsylvania. It's going to be throughout. And if we do get a second wave, like everybody's anticipating, it's going to happen again. And so I'm hoping that perhaps some of the solutions that are, you know, mentioned, you know, maybe more credits potentially, or something that could help solve that problem. So it's going to be those nicks, those cuts, the $2,000 to $50,000 cut, the $75,000 cut for timing. That's what I'm most concerned about.
You know, with the timing too, something we've looked at is some deals stress test very well with timing, where there can be, you know, if place in service is not an issue, there can be delays, and if capital's delayed alongside it, and we know that going in, that may be a thing. It may not really be a, you know, too big of impact, so long as we're, you know, adjusting for that and prepping for that in the front end. something we've seen is when you have an acquisition rehab deal that you have to place in service by year end, or you would potentially, if it's one building and you would potentially lose the credits for that year if you're not placed in service, that's a big change. So, those deals are specifically at rehab. If there's multiple buildings, it's not as big a deal. If it's one building, we really got to get, substantial completion by year end to get those credits. Otherwise, you would lose a year of credits. So that's certainly big. I think, something that's unknown right now is that we haven't touched on is construction costs. And I don't know, it's very challenging to understand what comes from that. On deals we're closing now, we've had price increases from contractors just prior to close, with subcontractors having trouble getting subcontractors on site. Now we've heard from others that, overall the cost of oil is down so much that it could be that certain supply chain, areas are less expensive. Supply chain in general, what is that like going forward as far as trade goes? There's a lot that's going to go into that. So I think that's something we're looking at, is construction cost unknowns. Now, if we can, there are some things to understand too, that when a deal gets awarded and we look at it from the time we have a commitment through the underwriting process, there's still a lot that can change, I think, too, as far as construction costs that we need to anticipate for, and whether there's delays in closing, changes in timing. So it may, I'd be prepared that deals may change even, a little bit more, which is out of, I think, a lot of people's control. But between the point of commitment and closing, there could still be shifts in construction costs, timing, another wave, changes to ACT rehab, construction process, whatever it is. There's still a lot of moving parts.
And we've touched on a number of different things as we've all talked about it. It is our AMI is going to drop. Are your rents at max LIHTC rents, and will you be able to actually increase the rents the way you anticipate? Again, we talked about relocation policies and that sort of thing for tenant in place rehabs. It really is. There was a question earlier on this that Macy and I have been going back and forth on, that the stressors that we're being asked to look at are changing weekly. And so it's hard to tell you exactly what the underwriting standards are going to be at any given time. Is it stressing it 2 months? Is it stressing it 6 months? Is it stressing it, okay, if we have a second wave and it starts in October and you can't do anything until January, what does that do to all of this? We're being asked by developers all the time, are you going to allow a release of the reserves? Are you going to allow a release of the reserves? And it sort of depends on where your deal is. Is it with a proprietary investor where we have to have approval? Is it not with a proprietary investor and we have the approval? So it's we're dealing with it on a one-off basis on many occasions, but it's going to change. So getting your deal in early, letting us take a look at it, let us stress it the way we're hearing our investors want deals stressed at any given moment. And we'll get back to you with, hey, listen, if you do this, it'll be an easier sell in the end.
Thank you. Chad, this question might be for you, and I don't know if you were planning on addressing it later, but is MSHDA thinking about any strategies to fill gaps that emerge closer to closing? At different times, you used to allow a % increase in credit, had a soft subsidy, etc.
Yeah, so it's something that we've definitely been thinking about. I think as we're hearing all the discussion around equity and the potential adjustment and things like that, I don't know that now is necessarily the right time to come out with exactly what a solution is, because I think as you're sort of hearing now that it's sort of changing kind of rapidly. From our standpoint, we have the June 1 round scheduled, so we'll be accepting applications at that time. I've talked with some syndicators already and know that, okay, they're putting together equity letters, and, in a market like this where things are, changing quite rapidly. And I think what we have to do is get through that round. And then once we're through the end of that round, and I was going to sort of touch on this a little bit, but we'll probably have to, like we have in the past, get an update to sort of, communicate with the developer and the development company and say, okay, where are things at, and the equity provider, and then sort of see where we're at that point in time. certainly if things get to a point where deals just aren't working because the equity markets have dropped to that point, then yeah, I think we'll definitely have to consider if there's things we can do like we have in the past. When back when the election happened and things dropped by about 10 cents, we had to do something then. So I think from our standpoint, I don't believe that right now is the right time to say, okay, this is the solution, because I don't know that we totally know the challenge that we're dealing with yet. But I think it's something where we're definitely thinking about it, and we just have to really communicate to understand it. And we want these deals to happen, just as much as anybody else. So.
Thank you. Moving on to the next question. As an industry, are we looking at adaptive reuse, repositioning, and repurposing other asset classes like hotels, student housing, retail, and other conversions?
Let me say this much, and Mike, you're going to remember this, from our 2008, 2009. Vanilla deals are going to be king. And so, and I hate to put it this way, but it's really the truth. In markets like this, investors want simplicity. They want a streamlined level of sources, and the construction complexity to be at a minimum. So the only strike against adaptive reuse is all the things that come with rehab, especially in a hotel to apartment, which you think would be easy, but God knows what it is. So I would caution, not to say you shouldn't do it, but just to be forewarned that the more moving parts, the more sources of funds that you have, because these projects are very expensive, and until they fix the 4% rate, these things are going to be a challenge, and it'll be even more challenging because the market is going to be clamoring for the easy project.
So the next question is, will the current COVID environment influence funders to rethink the importance of single-family affordable housing?
Well, I don't know if is that a question for MSHDA as far as funders go? I mean, allocating resources, I don't know. I can say that, there is, we do come across tax credit deals that are single family. I guess I can't say I don't know if it would be impacted more or less as far as with the demand. I think there will be a constant demand. I think, though, to Macy's point, wanting strong deals, the thing we run across with single family is it scattered site? Is it one location? Is it there's a level of complexity with that. So I think there often can be caution with that if it is something that's of scattered site nature.
Yeah, it's just echoing everybody else, it's taking the hair off the deal. It's getting it as vanilla as possible. Macy mentioned funding sources and that sort of thing. We're being asked, well, I don't know who this from the investor. I don't know who this source is. Is that money going to be there at the time that this deal closes? Is it going to be clawed back? I had one deal, not in Michigan, but had state credits, state historic credits, federal credits. And it wasn't that the deal was bad. It wasn't that the deal wasn't in a good CRA market. It's just no one wanted to deal with it.
Yeah.
This is too complicated for us right now. We don't want to close something like this. So as far as I know, the deal's sitting out there, so I'll let you guys know about it.
Since Spencer and I are the only ones that don't have hair on this on the panelists, and I'd say, yeah, we know about vanilla bald. We know that. So, yeah, I think let's go to scattered site. It's an interesting topic because and I think this is also vanilla, simplicity, and economies of scale that will also be important. So, and this comes down to, so if you, by nature, doing single family detached or even townhomes, you're going to build less units, deals will be smaller. So that might work for MSHDA because the allocation will be less, but then, I don't know, it's like these investors are looking for this sweet spot. So if you've got less than $5 million in equity, this might be also a challenge. So that $5 to $7 million number, I don't know about the rest of you guys, but I'm thinking that might be that sweet spot for most investors. That's that's a deal of some size, makes sense, or as opposed to doing a really small deal that might work better for the allocation.
Yeah, I would expect that the smaller the deal, the lower the price.
Yeah.
Mm-hmm.
Thanks.
Yeah, and I know from our standpoint, we've done both. We've done single family scattered site, development, and obviously the more standard, development and one building. And I mean, there's benefits to both for sure. We haven't had internal discussions to say, okay, this, COVID is going to shift us to focus more on the one than we did in the past, or anything like that at this point. I guess if things change, then we'll address it at that point. But to this point, we haven't had discussions like that. So
thank you. So we have 12 questions still open. Let's go through one or two more, and then Chad, I'll hand it over to you so you can give your updates, and then we'll open it back up for questions, and we'll try to get to as many as possible. So the next question is, are you seeing any opportunities to leverage opportunity zone investments for OZ investors? And what are those returns looking like for LIHTC? If I have an OZ investor, what's my timing to make that investment? If I'm a developer, what's my timing to apply and secure LIHTC for development? That was a big question, so let me know if you want me to repeat any of those parts.
Well, I would say this much on OZ. Capital gains are going to be hard to find currently. I mean, in the current market, they might be few, they might be there, they may not be. So I think OZ going forward is going to be somewhat of a challenge. And I also go back to my earlier point, which we've all sort of said, vanilla deal is going to be king. So an OZ deal by its very nature with LIHTC is going to be complicated and, somewhat of a hot potato. So, in terms of return, who knows? It's impossible to say, what these OZ funds are going to be projecting out in terms of what they're looking for. So I would say if you can, I kind of view it as like sort of holding on to, a storm, a tornado. You're trying to really put that energy in a bottle. It's really going to be tough. So, it'll be bumpy. If you can pull it off, great. I mean, I think that's, but it's going to be very difficult.
And investors are looking, we just closed an opportunity zone fund, but the investor that we had in that was looking for workforce housing. They were looking for missing middle. They invest in LIHTC on one side and they didn't want to mix the two. So it's up to the investor to decide, okay, does this work for me? Does it not? Okay, it's in an opportunity zone. Great. I'll take a little of that, but it's not going to change my pricing at all.
Thank you. So the next question is about timing and deadlines. So I think, Chad, you're going to cover that. So we're going to move on to the next one. And if we don't, I'll come back to it. Are you seeing any change in development project structure in terms of multifamily housing not being a safe alternative, and thus the projects need to allow for new or unique spacing to create more safe places for residences? Curious if the actual physical space construction is changing in light of COVID.
That's a fantastic question. Really a fantastic question. And I don't have an answer for it, but I would venture to say that the answer would be yes. And that, anybody who can build to that in the future and can afford it at this point, absolutely. But it has not come as a requirement. But certainly any deal that's doing it in the future, it's a great, all of us have to tell stories to the investor aside from just the sheer numbers of it. And that would be a very good story to tell.
Yeah, we helped a number of projects change their computer rooms into telemedicine rooms, and I think that for senior deals going forward, as we see the world changing and wondering whether it's actually going to go back to the way it was or whether it's going to stay changed, taking a look at some of these things, and we have a handful of developers who are doing that. I haven't seen one yet, other than this retrofit, but I know that there are folks out there taking a look at, okay, how am I going to change it? Jan Graff at Mercy Housing, they were hit pretty early on with some COVID in some of their senior buildings, and I know they're taking a look nationally at how they actually develop projects going forward.
Mm-hmm.
Thank you.
Nothing yet. I was say nothing yet in plans, because I don't think anybody, plans are already pretty much in the works for applications and deals we're looking at right now. So it was prior to this all coming on, but I agree. I think something certainly to consider going forward.
Thank you. So we're at the 10:45 mark. So I want Chad to have the opportunity to give his updates, and then hopefully we'll circle back to a lot of these questions. I think they're all interconnected. So Chad, I'll hand it over to you. And folks, thank you for asking such great questions. I promise we will try to get to them after Chad's updates.
Yeah, and I'm going to try to go fairly quickly through these things. And then if there's anything that I gloss over that people want to know more, you can ask. So then we can have time to address some more of those questions. So I wanted to kind of hit on a bunch of different things that I'm sure a lot of people have already heard about, just to kind of give people a little bit of an update and tease out a few things that, we're looking at for the future, which is similar to what we've kind of already been communicating in the past. So as I'm sure you all know, we have the June 1st funding round coming up in, oh boy, really soon here, less than 2 weeks. So, which is good. That round had been pushed back 60 days, so it's good to be able to have that round. And we have about $17.5 million of credits available for that round, so it's going to be a good size round. We've already got quite a few applications submitted to us, or at least people utilizing the electronic submission process that we put in place. And it seems like that's been working fairly well so far. A lot of people have requested access to it. And I think it's probably something that we'll try to keep incorporating going forward too. We feel like it's a pretty good system, at least as a starting point. And we'll probably try to use it, I guess, either that or something else, to accept 8609 and 10% applications electronically as well. I've had quite a few people reach out to me and say, hey, I have a 8609 application or a 10%. Can I send it in electronically? And we've been accepting those either via email or, setting up a folder through this system if we can't do it through email. So we're trying to make steps in that direction. And I think so far they've been going pretty good. I just have one reminder for people who are submitting their application electronically through that SharePoint site. We want to just ask people to submit things in PDF. It's easier for us to look at rather than having like a Word document or Excel document. We just feel like that'll be better for everybody. So just a reminder there. We've been getting a lot of questions leading up to the funding round, which is encouraging. I mean, a lot of people have deals that they've been working on, and the questions we've been getting are fairly standard questions, and which is good to hear. I mean, I know when mid-March, when all this started happening, everything was so unclear and unsure at that time. We didn't really know where we were going to be at this point, and I feel like even with the conversations that we're having here about equity markets, even though there's a lot of uncertainty, I am quite encouraged with where things are at compared to definitely where they could have been at this point in time. So I think there's a lot of good takeaways here that we can work with. So as we start getting into our funding round reviews for the June 1st round, we have had some layoffs of state workers. So the tax credit staff is only working 4 days a week. Some have Monday off, some have Friday off. And so we'll be doing our best to try to, go through those applications, do those reviews as quickly as we can. I think we probably, under normal circumstances, we would have had all those reviews done mid-August, hopefully. It'll probably be September with everything that's kind of going on and all the coordination that it takes and the reduced staff time. But we're going to try to get those announcements out as quick as we can because we feel like that would be good for everybody. And then I know that we kind of touched on it a little bit here earlier, but I think when we go to announce those awards in September, everybody can kind of plan on that. At that point in time, we'll be probably alongside of, telling you, hey, you're in a position to receive an award, sort of reaching out to have a bit of a conversation with you and with equity providers, just to kind of see where things are at that point in time. I mean, we have to, move forward with deals. We have to keep doing deals. We know that. And certainly we're not trying to create any sort of a gotcha situation or anything like that at all. But I do believe it's good for everybody to kind of be on the same page and have all the information. So, and at that point in time, it'll help us too, to be able to, say, okay, how are things going? And from more of a broader standpoint, a general standpoint, to determine whether there's things that need to be done to help deals to keep moving forward or not. Obviously that comes at a cost, and we want to, sort of be careful and reasonable with how we do that. But, I think communication is going to be a big key part of all this as we work through these things, and us reaching out at the end of the round to sort of reconfirm equity or find out where the pricing is just going to be another opportunity to communicate a little bit more on that. So I think people can kind of expect that. I think a lot of people are wondering, and this is probably what that question was related to, deadlines and such, is when the next funding round is going to be after the June 1st round. And we've been talking about that internally, and we're talking about it in conjunction with a couple other items like the pass-through program and things like that, to sort of figure out what our overall strategy is going to be for going forward. And so that's the funding round timing has been a part of that. I think people can sort of plan on, since we had a 2-month delay for the April 1st round, that there will probably be at least probably a 2-month delay for the October 1st round as well. Whether that's December 1 deadline or later or a little bit earlier, we're going to come out with some more guidance here very soon on that. But we're trying to be sort of careful and conscious to make sure that we give those applicants that applied in June 1 enough time to be able to receive the news of whether they received an award or they didn't, and they can decide whether or not they want to apply and what they have to update for that next application round. Sometimes when we compress those timelines so much and they get so back to back, it makes it very difficult and challenging to sort of coordinate those things. So we want to make sure that we're giving enough time there, but we also want to make sure that we're having that round as quickly as we can too. So we're trying to balance those two things. Along with those things, we're talking about the QAP, and specifically for that fall/winter round, what QAP that will be under. I think that people can sort of, plan pretty much on that. It's definitely not going to be a brand new QAP. It's going to look very similar to the QAP that we have right now. There may be a couple minor changes, a couple minor tweaks that we feel like we need to make. And there'll be focus changes. We want to make sure that, people that know the QAP right now, they don't have to totally understand a whole new QAP before they go into that next round. So we're having discussions right now on exactly what that looks like, and we'll be coming out with that very, very soon. But I think that's the basic direction that we're kind of thinking at this point in time. As far as I'm covering a lot of stuff here, so if people have questions, and if anybody wants to email me or talk to me personally, I'm happy to talk more about this stuff anytime. But we're also talking about the whole rewrite of the QAP too, which will take some more time, and that would be something that I think we would sort of plan on maybe having in place after that fall/winter round for the round after that. And that timing of that process, we're probably going to have to, if you remember sort of where we left that off, we left it off where we had one round of focus groups. We were drafting the QAP, and we were going to put it back out for focus group comment, and we never really got to that point because everything happened with COVID. So we're talking about sort of where do we restart that process? Do we restart it with doing the focus groups again? Do we have to make some changes that we've sort of experienced with the COVID crisis and everything like that? So I think we'll be restarting that QAP process here fairly soon, and at least restarting the discussions and things so we can start kind of getting on a path to put that in place eventually. Because I think that we did have some very good discussions going with the QAP, and I don't think that, I mean, we're not, we still believe those are good discussions. Those are good strategies. But we also want to make sure that we're sort of taking everything into account with everything that we've kind of been going through. So that's where we're at with a few of those things. Just as a couple side notes, we have sort of allowed the IRS allowed us to give a 6-month extension of the 10% deadline and a 12-month extension of the place in service deadline for projects that were awarded pre-January 2020, where we had the disaster declared. And so we've been allowing that for any projects that need it. And we've had quite a few that have taken that on and wanted to do that. So we've been encouraging any projects that feel like they need that to ask us, and we can make those adjustments. A couple other things, just more minor things, I guess. We've been doing a lot of the tax credit staff has been doing pretty much full capacity through the whole stay-at-home order, which has been great. It's taken a lot of coordination, but they've really caught up a lot on the 8609 processing, 10% test processing, which I think is really going to put us in a good spot going forward when we do have to start focusing more on this funding round and the round after that in QAP. So we've made a lot of really good progress on 8609s, and the staff's worked really hard on that. So that's been a really good thing that's sort of come from all this as far as catching up on that. So I don't want to take a lot more time, but I do want to make sure that I'm answering any questions that people have and giving folks an idea of kind of where we're at and things like that. But I also want to make sure we have time for the other questions that people have already asked too. So.
Thanks, Chad. Yeah, we've got a mix of questions for the group. So let me, just looking through these. I think this will be a quick one. How do you think the 60-day delay will affect the total number of applicants for the June 1 round compared to past rounds?
I have not really heard of anybody specifically that has said that they will not apply. I mean, it could, I really don't think it's going to be much of a change at all, actually, because people would have already had to request market studies, and we did the delay in a way where we tried to make it so nobody was really being harmed by the delay. If somebody had items that were already sort of in place for the April 1 round deadline, we're still going to accept those as far as the timing of them from a June 1 standpoint. So, I don't think it would have, in my mind, I don't think it's going to have an effect on the number of applications we receive.
Thank you. Have investors and or MSHDA views of site selection changed in light of COVID-19 and specifically proximity to city centers? Are there changes expected in the next QAP?
I guess it's a good question on whether, any changes that can be expected in the next QAP. I mean, one of the things that we're going to be doing and that the state's going to be doing is, sort of a robust assessment on, COVID and all the impacts and things like that. I'm sure there will be some things like, maybe not that exactly, but some things like that we'll have to discuss as part of the new QAP process related to, to COVID. But those are I guess that's why we have a, sort of a robust QAP process where we're taking input from all different places and then we're discussing it and figuring out how best does it fit within the program. So I don't have a good answer on that, but that's something that I would expect would, come out as part of the process if that's a factor.
So Spencer mentioned that pricing is down 2 or 3 cents. What is the current pricing?
I'd say anything between mid 80s and low 90s.
I was going to say $1.05, but I think Mike's right.
And again, depending on your deal, depending on location, that sort of thing. But I mean, there are things right now pricing out and I hadn't seen this in a while, at like 85 cents.
Yeah.
So
I mean, I think we were, Mike, if you remember in 2008, 2009, the lowest I saw pricing drop was to 68 cents. And that's where we were backfilling against Fannie and Freddie leaving the market. Now, we don't have that situation now. So I think that's why you're seeing deals close now. We don't have this abrupt stop. But, you know, again, this is a buyer's market now, so they're going to get what they can, and the rates of return, you know, pre-COVID were, you know, pretty low to most investors, and so, you know, they're going to be looking for any place if they're going to put their money, precious upper tier capital, anywhere. They want to see it, you know, a very good rate of return, not what they've been seeing in the past, regardless of CRA. So I agree with Mike, and I think pricing might drop to potentially 80 cents before this thing gets done, if not lower.
Mhm.
That's me, Mr. Doom and Gloom. Oh.
Thanks, guys. My clients who are developers hear all the time what they need to do to change their deal to make it more conservative. What are the syndicators doing to their fee structures and upper tier reserve requirements to help deals? What are the IRRs each syndicator is looking to achieve?
Well, I can take a shot at that one. I think what are investors doing as far as changing upper tier reserves to help deals? I guess I can say at this point, not much. I think that the investors aren't willing to really take on additional risk. So that really is at the deal level more. So it has to do with, you know, having cushion in the rents, and, you know, having 6 months reserves, having a healthy construction contingency. There's going to be less giving on those things. You know, I think also it'll be interesting to see with the QAP how that may adjust. I mean, with pricing, low interest rates and things like this, we've been able to have deeper income targeting because you can still get deals to pencil out with, you know, lower AMI units. I don't know if there will be any shift with, you know, suppose pricing does go down to 80 cents per credit. In order to get deals work, we need more revenue. We need more of a first mortgage. You know what I mean? There's going to have to be a shift. We've been able to kind of stretch deals to get more deals done over time, where it could be that pulls back a little bit. But again, that would have to be, you know, potentially through a QAP process. But I think it's really, I don't think investors are going to be willing to take on more risk by giving on their reserves. I think it's going to be more at the deal level.
Thank you. So we're seeing a couple questions about vanilla deals and wanting some examples of what that actually means or what that actually looks like.
Ice baby. That's what that's what it looks like. Well, it looks like simplicity. That's what it looks like. It's simplicity of structure, simplicity of financing sources. You know, that you know, we're used to. I'm not saying it's got to be debt equity done. I mean, that would be great. I mean, right? I mean, but, you know, debt equity one source that's a MSHDA source that we're all used to, or home funds, you know. But when you start talking about 6, 7 sources that are kind of new, where they're quasi loans coming from entities that don't know about credits, and everybody, you know, that's where you start getting into this craziness. Gentlemen, you know, your reaction?
That's absolutely true. It's just make it look as simple as possible. You know, we've done deals before with nonprofits where one of the funding sources was philanthropy. You won't see a lot of those deals get done right now. You know, the idea that we're just, even a long-term sponsor, the idea that we can rely on the fact that people are going to donate to get the project done in the end, that would be a hard one to sell to investors right now.
Thank you. Given these unique times, are syndicators willing to be scored within a QAP regarding load structures and equity pricing?
Is that a question for MSHDA, or is that? I'm sorry. Could you repeat the question?
Yeah, of course.
I think it's a question for us. I mean, I think they're asking whether or not we're willing to say that based on our load structure would be a point scoring criterion for MSHDA. What we would put our load at the upper tier, and that a lower load structure would in fact, you know, mean better point score for MSHDA. So whoever submitted that question was probably an equity syndicator out there sitting in the weeds, kind of. Come on, call yourself out. I mean, I don't know. I mean, it really comes, you really can kind of see it if, we start throwing out pricing that's pretty high, you can see where we're going with our load structure, so I don't know, Spencer, what do you think?
Yeah, and I don't know how MSHDA could use that as a scoring parameter within their QAP. Like Macy said, I mean, pricing is going to come in based off of your load structure, and it's pretty evident what it is. So I don't think that, I'm not sure. I don't think that that's something that could really be validated with a scoring measure.
Yeah, let me also just add that I think when we're putting, deals that are going for application right now for MSHDA, I think we're working with our developers on what's a price that we believe we can take to market that makes sense. Now but it could land in different types of funds, could in the end be a multi-fund, could be a proprietary fund. So on the front end to even say, what is our fee structure going to be on this particular deal when it closes 9 to 12 months from now, or maybe longer, especially given now, I don't think we could even, put a number on that specifically right now. I think it's still pretty gray. So I think it'd be hard to do. And I think, I don't know, but I think fee structures aren't necessarily the same across the board on how they're collected when, and there's a lot of things to consider. So I think it'd be really hard to even put a number on that as far as the application timing, and also get an apples to apples comparison of what that looks like.
Yeah, and so many of the investors have different requirements, right? At load, at the upper tier reserves, or whatever it happens to be. That, okay, this investor pays up for deals, but they also have a really high, upper tier reserve requirement. So, great, I can pay better than everybody else, but if you're going just on load, this is the investor that's got the biggest load. So it would be very hard to do, and I think you could actually hurt projects and developers more than you would help by using that as a criteria.
Thanks, guys. So this next question, for the 4% direct lending application due to MSHDA on August 15th, third-party reports, appraisal, environmental, are delayed because contractors can't get into occupied units. Will MSHDA grant waivers for these reports, or what will MSHDA do to accommodate associated delays? And let me know if you want me to repeat, but how should developers communicate with their contractors to ensure the info required is attainable? The CNA market study requests are due to MSHDA on June 1. How will MSHDA direct their third-party vendors?
Yeah, so I know with the market study process, there has been some adjustments in talking with Dave Allen that they've been able to do to make sure that the market studies can still be completed with some minor changes that obviously to kind of deal with the situation we're in right now. So I don't believe there's any issue there. With other third-party reports and items like that, I guess, I'd be curious to know specifically, I guess, if there's issues with that or who's having issues. And certainly I think the sort of the key thing right now is just flexibility where needed. So certainly if there's more time that we need to think about giving, we can look into that. Yeah.
Thank you. Do you see any new opportunities coming for smaller rural projects, whether because of the COVID crisis or other changes to the QAP in the future?
So, certainly we were with the, sort of the prior QAP discussions that we were having, the big, sort of key topic was sort of geographical distribution. And I know that we still think that's a good priority to have, and that's something that we want to keep doing. And so, I think, our focus, one of our focuses, I believe, would still be on making sure that there's an opportunity in the QAP for rural deals. And I don't know that it necessarily is, you know, because of COVID or anything like that, but I do believe that that's still something we'd like to see happen. So.
Thank you. So this next question, how would investors like developers to trend rent growth in projects in the near term?
Is there a way to just income growth? What we've always done at PNC is just been 2% for income growth and 3% expense growth.
And I think that's sticking, but again, are you at LIHTC max rents, and will the AMI stay, will they continue to grow, or will they be flat and you won't be able to raise your rents? That's the part that we're going to look at. We're going to take a look at and say, we need to have 5% below max or something that actually trends out to show that you can actually get the rent increases that you're banking for if the AMIs don't trend up.
And I think that's the point that's going to hurt a lot of rural deals. That's going to, that ability or inability to make a deal work at a current achievable LIHTC rents, and to give that cushion to the market rate rents or to other LIHTC deals, and the argument's going to be, well, we are the only game in town, so to speak. And so again, a lot of this is going to be kind of check the box kind of stuff. It's investors are going to want to see blah, 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 blah. And there are 3 boxes, check, check, check. And if you can check all of them, you're good. And if you can't, you got a problem. And so this is where, the rural deals are going to get stuck in that potential grip on rent elasticity and, where they are in the market.
Okay, so the next question, Chad, how many credits do you anticipate will be allocated in the fall-winter round?
That is something that we're still talking about. So the June round is going to be for the second half of our 2020 credit ceiling, which is going to be about $17.5 million. So the fall/winter round is going to be the first round of our 2021 credit ceiling. And we've been talking about a number of different things regarding whether we keep doing it the same way we've been doing it with the same amount of credit we would typically have in that round, whether we put more into that round. And that sort of also, leads into the discussion. Like I mentioned, we still want to make sure that the QAP in that round, that developers who have a good understanding of the current QAP still would have, if they're looking at their deal under that QAP, that it would still be competitive under the QAP that we use for the fall/winter round. We are looking at, maybe making some very focused changes, but changes that, hopefully wouldn't make a huge impact on things that would change, whether a project would have otherwise been competitive. I don't have some real solid, things that I can really report there, because we are sort of heavy into discussions on what we think is the best strategy for it. But I would think, either it's going to be the same amount that we would typically have had in that round, or it's going to, we're talking about maybe doing a little bit more if it makes sense. So, but we haven't decided on those items yet.
Hey, Emily, can I ask a question of Chad?
Yes, go for it.
Chad, we're running into problems right now with the issuance of 8609s, right? If you've got a project that has an 86, has multiple buildings, that is going to place in service in multiple years, and you're taking credits on part of that project in 2020 and taking part of it in 2021, and you can't take it if you don't have an executed 8609. So Mr. thinking about executing partial 8609s?
We have done that in the past, and we, not because of this, because this is sort of a new issue that we're running into, but certainly I've had a few people reach out to me, and it's more work, definitely, but if we need to do it that way in order to try to accommodate those deals, to make sure that they don't sort of lose out in that way, we can certainly talk about doing that. Yeah.
That's great, because there are some states that aren't and won't, and we're having to underwrite to that now going forward, and it's hurting hurting the deal. So that's good to hear.
So the next question, along the lines of simple deals, are 4-9 combined deals going to be hard to get an investor on board with?
I guess, you know, I would say it's hard to say, not necessarily. I mean, we're looking at some right now. It has to do with what, you know, how well does the 4% deal pencil out on its own? And back to, you know, we've talked about vanilla deals, the 4 and 9%. If I think it comes down to just deal type. I mean, if it's solidly sourced, if the deal pencils out well, and it's kind of just goes back to the same characteristics we've talked about with underwriting standards. Now, that may mean some of those deals are harder to make pencil out if we do have to provide a little more cushion in rent, provide, you know, as far as, you know, reserves, things like that. It may be a little more challenging. The thing that I'm looking at for 4% that are a little bit hard, we've seen on some deals, is you have to hit a certain rent level to be able to convert the term at a debt ratio that typically is pretty tight. So in putting cushion into those areas can push it to a point that the deal no longer works. So I think, you know, the same principles apply. It may make it a little more challenging, but, you know, but we're looking at them.
Yeah, I think that if you had asked that maybe year and a half, 2 years ago, it would be hard to get through right now. But I think we've all done enough of these and had enough of them go through the system that we know how to do that. And I think you're right, stressing them like we're going to do on every deal now anyway. That's one thing. But we know how to do these. So it depends on, you know, it's going to be location. It's going to have all the other factors that go into, you know, picking a good deal.
You know, Emily, I'm surprised no one's really asked a question about income averaging.
Just gonna say that, yeah.
I think did I just see one about income averaging or no? We do have one. So doesn't adaptive reuse help with disparate impact / fair share in urban markets when infill is challenging? And doesn't this allow for missing middle and mixed income approaches, combining LIHTC with income averaging? ?
Well, I can take the income averaging aspect of it has been somewhat of a challenge with investors. I don't know why they can't seem to get their arms around it, you know, especially when it comes to the next available unit. So there seems to be definitely this prejudice against income averaging with market rate and 80% AMI. So there seems to be this, you know, they don't want to see that. And so, but it's a critical need. I mean, I think, you know, income averaging is here to stay, and we just need, our side of the house needs to get used to it and how to mitigate those risks. But yeah, you know, hitting folks that are at a little bit over 60% AMI is going to be critical and going forward. And I think that helps when we can do that. So we need to get our investor base more used to it.
You know, I think for the adaptive reuse piece of that as well, you know, it's interesting because I think oftentimes adaptive reuse, there are situations where it makes absolute sense for a certain community to repurpose a building, and that for that community in that space, in that neighborhood, it absolutely makes sense. It's the fact is they're challenging to underwrite. They're very challenging because they often cost more, even though there's an existing structure. You know, you say, well, there's an existing structure, you can convert those units. Well, they often cost far more per unit. And there's so many unknowns as far as operating them. There's often large spaces. If it's a school, we have gymnasiums, we have wide hallways, the utilities are through the roof. The cost per unit to operate them is more, you know what I mean? So then they have to be sourced differently. They cost more to construct and more to operate. So I think there's definitely a place for them, but it's, you know, they've really got to be sourced well, and then given the current environment, that makes it even, I think, a little bit more challenging. So again, the community level, I think it definitely makes sense, and there's been great examples of ones that have been well done, but they are not the vanilla deals that we've talked about. So I think if in a perfect world, I'd love to see more of them and have them be fully sourced, but it gets tight.
And it's going to be the developer's experience in doing them too, right? If you're a developer and it's your first adaptive reuse, that's got hair on it. If you're a developer who has made their living doing just that, that's an easier sell.
Absolutely.
Easier sell. This is where it gets a little bit more difficult, but maybe not. I mean, I think MSHDA's been pretty good about this, but you're talking about construction contingency in particular. You know, this is, you know, the more you can have in construction contingency on an adaptive reuse, the better it is. In other states, they're not so kind. to having increased construction contingency. And so, again, this is one of those things where we talk about a vanilla deal or more conservative underwriting structure. This is, you have a more construction contingency. It's really going to help. It's going to help a lot.
And Ben, you have a comment from Michelle, your colleague, when considering income averaging, stressing rents will be more important now, having a discount on 80% units. So Mitch is asking, are states starting to look at using CDBG-CV as a source for the emerging gaps in LIHTC projects?
I know that I know MSHDA's been involved with some discussions about CDBG. I do not have a good handle on whether that's something that will be happening or not, to be quite honest. So I think we'll have to stay tuned a little bit to see if that's something that becomes a possibility.
Yeah, Mitch,
go
ahead.
Oh, I'm sorry. I was going to say one of the things. I mean, this isn't really going to help with gap. Well, it could, I guess. But I see a lot of projects that don't want to include project-based Section 8. Really aren't trying to reach out to housing authorities to secure or MSHDA to get project-based Section 8. I see a lot of 811, which is great. But one of the greatest mitigants that we can have right now are hedges against rent loss, or as Mike was saying, sort of doing the AMI test. Project-based Section 8 can solve a bunch of those evils, one fell swoop. And so, I think that's one of the things I'd like our folks to take away with is that, trying to pursue more project-based Section 8, whether it be through the local housing commission or through MSHDA, really critically important and will help a lot of these. You have a good rent structure as a base, adaptive reuse, plain vanilla deal, however you want to describe it, it really is going to go a long way to help.
That goes with RD too, at least for us.
Thank you. So the next question is a long one. So again, let me know if you want me to repeat anything. The yields that investors are willing to accept on their LIHTC investments average 4.75%. Economic investors that are more focused on yield are able to demand yields from 5.5 to 6% in the upper tiers, and they're unlikely to accept less. Development costs, equity capital, and property management costs are rising. With this cost of finance, can we do affordable housing?
Okay, who asked that question?
I don't know.
Come on. I mean, and look, I mean, look, I guess I go back to 2008, 2009. Mike, you guys, forgive me. It's so prevalent to me, because it was such a traumatic experience, for those of us who went through it. Are we going to survive? Absolutely. If pricing drops to 65 cents in the near term, yes. But, in 3 years from now, we could back up at, at 98. I think there's, affordable housing, when you start looking at it on its general level, from our side of the house is a worthwhile investment. I mean, we're all trying to figure out in the future, as Mike was saying, what rate of return is going to work for an economic investor in 2020, 21 and 22, all that kind of, yes, that's all there. But I think in general, when you look at, as an asset class, this is your, affordable housing, LIHTC, and with project-based Section 8, that's your recession hedge. And it's also, so, our product has a proven track record for, close to 40 years of working. So there will be affordable housing. It will continue. Our market will pick back up. We're just going to hit a bit of a dip. And, this is why, I guess, for those who know me, and I always preach, you never know when this is going to hit. You never know this is going to hit. You never, it's always doom and gloom. I got that from Joe Hagan, right? Mike, it's like the shoe's always going to drop for the next 3 years, right? And so this is, I always feel that way. And so, we always try to hedge towards being more conservative. And so I think, yes, there'll be affordable housing. We'll be able to pull it off. Yes, it's going to be more challenged. There'll be other sources that'll be available. And lo and behold, the great miracle was going to occur, which occurred in 2008. Larger contractors will be searching for more work, which means they're going to drive the price of construction down. I think it may not be dramatic, but another 5% downward trend on construction pricing, will go a long way. So, that's my take.
I mean, deals got done. The first deal I worked on, and it was a while ago, but the first deal I worked on prior to this life, syndicator, we got 54 cents for. And deals were getting done in the 80s, in the early 90s, they were getting done. We went through the downturn in early 2000s. We went through corporate tax reform. Our industry bounces and it still produces.
Yeah, there will be a constant demand for affordable housing. There's support. You saw in 2008, 2009, TCAP dollars becoming available. I mean, we don't know yet what other products may be available, what may be coming out, but I think that there's constant demand, there's sufficient support. And, you know, I think something I talked about before too is I think over time QAPs have, because of pricing and because of the dynamics of being able to stretch for more deals to get done, there may be a little bit of time that we have to adjust whether you allow more basis boost for credits on deals. I mean, you can make adjustments through that to allow more credits to get the deals so they can get done. So there may be a little bit of, if there's a long-term change in pricing, a little bit of a lag there that you have to bring in additional soft funds, additional support, things like that. But they're, right, I think deals will continue to get done. If there's pricing is less, and maybe you can't stretch the credits quite as far, but you never know. There's also, you know, still the push to fix the 4% credit. There's still, you know, a lot of support for expanding the 9% credit. Now it hasn't quite got there yet, but there's a lot in play. So there will certainly always be a place for it, I believe.
Thanks, guys. So we have about 3 minutes left. So I want to address two questions really quick, just from a CEDAM standpoint. Somebody is asking what funds are available through the CARES Act for GAP or helping with rental assistance. I can't speak to the GAP, but I know CEDAM's advocating for like direct rental assistance and mortgage assistance. So, you know, stay updated with us on that. And somebody's also asking kind of a high level question about NIMBYism and will that be more challenging post-COVID? So I do want to pose that question to the group, but also just want to say I'm interested in that conversation and what community engagement looks like around affordable housing as we move forward. So I just kind of want to put that out there generally, but I don't know if the group has any thoughts on either of those things either.
I mean, not any like real specific thoughts, I guess. I mean, NIMBYism has always been a challenge, even pre-COVID, I think. And I think, I mean, typically it seems like it's just because, you know, there's not a real great understanding of, you know, what affordable housing is and how beneficial it is and how it's actually done, you know, in such a good way. So, I mean, I think we just need to keep finding different ways to tell that story, tell that accurate story in the way that makes sense and the way that resonates with people so they can understand how it actually, what it actually is. I don't know if it'll be more post-COVID, but I think it's just, I mean, that's always something that we have to be good about is telling that good story.
So let's do one last technical question before we wrap up. So in light of the response regarding rents future trending, increasing unemployment, and the general economic contraction, how will income averaging be viewed going forward, particularly 80% units? And forgive me if we already touched on that more in depth, but if anybody has anything to add, please go for it.
I think it's going to be, come down to the market study itself. You know, you're going to have, you're expecting, you say, okay, well, I'm going to plug in some 80% AMI units, and I'm going to plug in 80% AMI rents, and then we get the, you sign out, we're all working together, and you get the deal. You order the investor orders the market study, and they say, look, the 80% AMI rents might be less than the 60% AMI maxes, and that's what the achievable tax credit rent's going to be. So whatever advantage you have is lost. That's the kind of underwriting that you should expect. Having the higher the AMI, the more the cushion that investors are going to expect to make sure that we don't run into an average income problem or average, and it's, again, this is going to take time to overcome, although it's taken years to overcome Section 8. So who knows? But yeah, I mean, it could be an issue.
Yeah, and I think that it's going to be location too, right? There's a difference between doing 80% units in Ann Arbor or doing them in Port Huron. It will come down to market study for sure, but investors will look at that a little bit differently depending on the area you're in.
Mm-hmm.
Well, thank you guys. We have a few more questions, and what I'm going to do is copy and paste those and put them into a document, and send them your way. So if you're able to answer those questions for those folks, that we don't leave them hanging there. But I do want to be respectful of everybody's time. So again, I just want to thank you all for jumping on board with this and having this really great and insightful conversation today. We appreciate you taking the time to do this. So thank you. And for all the folks that are on, just be in touch with CEDAM. Let us know how we can continue to help you, what additional resources and information you need from us. We appreciate your feedback and are seeking your feedback. So when I send out the recording of this, feel free to just respond to me directly, and continue to look out for future offerings, because we're constantly talking about other ways that we can have conversations like these in the future, ahead of future funding rounds, etc. So be on the lookout for that information. And thank you again to everybody for joining us today, and take care and have a great rest of your day.
Thanks, Emily, for organizing. Really appreciate it. Great job, everyone. Good seeing everybody.
Thank
Thank
you.
you. Be safe.